Hello and welcome everybody to the next installment of Diversified's quarterly investment review and economic update. My name is Mike Hornwath. I am the Chief Investment Officer at Diversified Lifelong Advisors, and today we're going to go through the fourth quarter of 2020, and really we're going to recap all of 2020 in general. So turning our head to what happened in 2020 from a market perspective, really everything was positive. So if you look on the screen, across the board, you see a lot of pretty positive returns despite how volatile markets were and how the economy struggled due to the COVID pandemic. For the year, the MSCI ACWI, the All Country World Index, which really represents all global stocks, was up about 16.25%. Fixed income, represented by the Barclays US Ag Bond Index, was up about 7-ish% on the year. But you can see across the board there were pretty strong returns, which were mostly generated in the second, third, and fourth quarter of the year. US small cap, which represents smaller companies in the United States, performed probably the best out of all asset classes at about 19%. Turning our heads to what drove markets, because I think it's important that we would look at what actually drove the performance underneath the hood, and it's not that surprising. The things that performed the best were those stay-at-home type of stocks, information technology, online sales, online retail, things like that performed very well. You think of the Amazons or the e-commerce. You think of different technology companies like Zoom who really took off. And then if you turn the page to what struggled, it was similarly things that make a lot of sense. Energy and travel being the two that really struggled. We saw oil prices really fall from a lack of demand, and we saw entertainment and travel industries, whether it be airlines or whether it be cruise ships, cruise lines, really struggle from a performance standpoint. So in the end, what performed well was mostly technology. Healthcare also performed rather well, but really the online retail was what performed the best by far. So when we look at 2020 overall, we saw a really big peak to trough fall in that February to March timeframe. We saw about a 34% drop in the S&P 500 and the MSCI ACWI All Country World Index during that about 1 month period. After that, through the rest of the year, we saw about a 70-ish% return from the market bottom on March 23rd through the end of the year. In the second quarter, US GDP was down about 31% on an annualized basis, and then in the third quarter, we saw something around a 33% annualized increase in US GDP. What drives GDP? I think that's important to think about why it was down so much and how it recovered. And the chart on the screen you can see, and I always talk about it, consumer spending really drives a lot of the economy. So if consumers aren't confident and consumers aren't employed and consumers aren't spending, the economy is going to struggle. So in the third quarter, we finally saw some of the consumer spending really pick up. Part of it was government stimulus. Some of it was employment picking back up. From an employment standpoint, we saw unemployment from its lows. Right in February, it was somewhere around 3.5% at its low. Unemployment rose to up over 14% in April. And then throughout the rest of the year, it slowly dropped to a point where it was around 6.7% to end the year. And as I just mentioned, really what drove returns were big tech, some healthcare. Those sectors performed really well. While on the flip side, we saw energy, travel, entertainment really struggle, with many people being forced to stay at home, many industries being shut down, many countries having to install lockdowns for their populations. So where do we stand going into 2021? I think one thing that we get asked a lot, I get asked a lot personally, is the stock market's valuation. And really what that means is stocks are kind of expensive. There are different ways you can test the relative value and cheapness or expensiveness of a stock. You can use a price to earnings ratio, so how much you're paying per unit of earnings of that company, or the price you're paying per unit of book value of that company. There's different metrics, but really across the board, stocks are pretty expensive by every metric you use. So we do have a higher valuation environment. Part of that is driven by bond yields and interest rates being so low. And speaking of that, as we go into 2021, that is something we have to consider. Bond yields, interest rates, they are very low, and it's likely to continue staying low. The Federal Reserve has pretty much made it their mandate that they're going to hold it low, especially the short end of interest rates. They're going to keep the short end, or the shorter end of interest rates, low for 2-3 years, depending on what happens from an economic standpoint. The Federal Reserve uses interest rates really to control unemployment and control inflation. Their job is to try to keep inflation low but positive, keep unemployment low, and they can use interest rates to help manipulate the economic conditions with which those are moving. We also saw rising debt levels at both the corporate and the government level. There's no surprise that the government has been spending a substantial amount of money to pump money into the economy from a fiscal standpoint, right? The Paycheck Protection Program, direct payments to individuals, small business loans. We also see on the monetary side, we see the Federal Reserve spending a lot of money to buy bonds and to keep liquidity where it needs to be. So we really see this rising debt level. In the short term, we don't see this as a problem. Over the long term is where we need to really understand the impacts of more and more government spending, more and more national debt, where maybe we'll increase inflation, it will maybe devalue our currency, but these are things in the long term that can become an issue. In the short run, we don't see them either as a problem. But we saw substantial fiscal stimulus in 2020 and going into 2021 with the new regime change in the United States with Biden and Harris, that ticket getting into office, along with the Senate now being 50-50 between Democrats and Republicans. We do think that more is going to be done from a fiscal and monetary stimulus standpoint. How much, that's really to be seen, but we do think that is going to be a tailwind to really help stocks be able to maintain the levels that they're currently at. So going into 2021, what are our expectations? We think that the economic recovery will continue. It will likely be slow, especially for the first half of the year, but the pace and the amount of recovery will be dictated by really the distribution of the vaccine. It's so important that we distribute and get as many people vaccinated so that more and more industries, we talk about energy, we talked about travel and entertainment, those industries really need people comfortable being in public amongst larger groups of people in order to really kind of take off. So the vaccine distribution is going to be key in that recovery. We do think the second half of this year we'll see some sizable economic growth because of that distribution really starting to pick up. But it'll be a slow return to normal. We certainly don't think the middle of the year we're all back in very, very large gatherings, or even by the end of the year. But we think that it will slowly get back to normal across multiple industries, whether it be restaurant, travel, things of that nature. While stocks are expensive, our expectation is that they can continue their run. Low interest rates will help that. Additional fiscal stimulus will help that. And then people returning to work, that unemployment rate coming down, will continue to help that. But as I mentioned, we do think it's probably towards the second half of the year where we start to see GDP and corporate earnings really start to pick up, as the first half of the year will likely be clouded by the distribution of the vaccine and really an effort to try to pick that up. We also expect that the Federal Reserve will keep interest rates low, bond yields will be low, and we need to be smart about how we build our bond portfolios, because it's important that they still have a role in our portfolio, even though that their yields are very low going into 2021. So how are we positioning portfolios? I think that's important to talk about. we still prefer stocks over bonds. If we're going to look at them from a relative standpoint, stocks are still relatively cheaper than bonds. We still think that stocks have room to run, where bonds are going to be a little bit challenged in the low rate environment. That doesn't mean we have to give up on bonds. It doesn't mean we don't believe in diversification. It just means that when we look at the two of them combined, we don't believe it's time to run to bonds or run to cash. We think a diversified portfolio built upon your risk tolerance is still valid. It's still going to be important for the long-term success of your portfolio. We do think that beaten down areas like financials, like energy, like travel entertainment will at some point recover. They already have somewhat in the wake of the election and what expectations were around that. But we do think that IT, technology, and healthcare really they have staying power. It's called secular growth. We believe that they are here to stay. So this movement towards stay-at-home technology, this movement towards online sales, it already had started. We think it will stay, and we think innovation in these areas will be vital for the continued growth of our economy. So, as the economy recovers, we really do think that leaning towards small cap and emerging markets, we see opportunities in both, meaning smaller companies over larger companies. We think U.S. large cap, it's had a really good run. Everybody wants to talk about the S&P 500. It's a very top-heavy index. It's also an expensive index across many metrics. We're not giving up on U.S. large cap by any means. All we're saying is we're going to start tilting portfolios, and we have begun to tilt portfolios towards smaller companies that perform better during economic recoveries. And we also look to see emerging markets, right? China, India, Brazil, Russia, South Africa, areas that are going to have faster economic growth than here in the United States. We look at those areas as opportunity for a rising middle class, for companies that are really innovating. We have to be selective about where we go within there, but we really like those areas moving forward. On the bond space, we really think that corporate bonds are in a better position than government bonds. Government bonds are expensive right now in the wake of the pandemic and bond yields really being pulled down. We also believe that the areas outside of core bonds, right, we call them the plus sectors, high yield, emerging market debt, these areas can add some value, especially with where the Federal Reserve is and how they're supporting the fixed income space, especially if the US dollar devalues. That makes emerging market bonds even more attractive when they're issued in their local currency. Things like that are what we're using to enhance return, enhance yield, add a diversification benefit. But we're still going to have our core bonds of government, corporate, asset-backed securities, and we're leaning towards corporate bonds over government bonds in that space. So in summary, 2020 was an event-driven recession. So when we say that, it wasn't driven by any bubble that picked up. It was driven by a pandemic that caused really rough times for most economies across the world. And markets have really recovered since then. Markets really recovered because of government stimulus, right? Government stimulus stepped in both on the fiscal side, so direct payments to people, the PPP loan, and monetary from the Federal Reserve stepping in to provide liquidity. Markets really recovered over 70% from their market lows through the end of the year. We think that 2021, especially the second half of the year, is where the US and really the global economy needs to catch up to where the US market got to. Remember, the US economy is different than stock markets. Right? They are not one and the same. They often move in tandem, and they will move in tandem, but not always at the same time. It's very unlikely that we expect any rise in interest rates from the Federal Reserve in 2021, and we do expect additional fiscal stimulus. And from a portfolio standpoint, we're going to continue to look for areas outside of U.S. large cap, for example, to add some value as it has gotten very expensive. So we're looking at small cap emerging markets to add some diversification benefit. In bonds, we're looking towards corporate bonds. We're looking to some of the plus sectors to add some value. So that's all I have for you today. I hope you enjoyed this. Hope you found it valuable. We'll be back next month in February to catch up on a specific asset class. So we'll return to those videos. But for everybody here at Diversified, I'm Mike Horwath. I am the Chief Investment Officer here at Diversified Lifelong Advisors. We ask you to stay wealthy, stay healthy, stay happy. Take care.